Hey everybody, it's the Chinchilla Pickin' Podcast. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. It is Monday, August 16th, 2021, and as always, I am here with Brandon Beaver. Brandon, how are you, man?
I'm good. How are you?
I'm doing well. I've had good days, I've had bad days. Today, I made a bad call in our little competition in Money Vikings, so that stung a little. But oh well, we will recover. We will recover because it wasn't that big of a drop.
You're not always going to be right. You don't have a crystal ball, right? So you can't tell the future 100%. But that's kind of what
with my bald head, but that didn't work.
That's kind of what makes this whole thing fun, is not knowing what's going to happen. But you just make your trades based on your instincts and charts and all that kind of good stuff. And as long as you're right more than you're wrong, then it's fine.
Exactly. As long as you're right more than you're wrong, you're fine. Yes. And you're right about, you got to use the charts, all the tools at hand, the things you subscribe to, all your subscriptions, yada, yada, things like that. And use those to come up with your, educated, reasoned decision there. And once you make the call, go for it.
Mm-hmm.
That's what I always say. Anyways, I know we have a little bit to cover. I know we want to get rolling on this, so let's go over the rules. Everybody knows the rules. Brandon and I get together about 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We do not discuss it. We save the live discussion to hear live on the show with you guys, and it makes it more fun that way, I think. We decided Brandon's going to go ahead and go first. He's going to lead us off, and then we'll go from there. Brandon, take it away.
So we've got the $1 trillion infrastructure bill that the House is going to take up, and it looks like they're going to return from recess, I think, on August 23rd. Nancy Pelosi said that they don't really want to take up that $1 trillion infrastructure bill until the additional $3.5 trillion spending bill is passed as well by the Senate. She wants both of those on her desk, and she wants them both to pass. That equals $4.5 trillion of more spending. So add that to the inflation that we're already seeing. Inflation, in my mind, has no end in sight. So, what I want to do... Did you just raise your hand? I didn't see.
No,
okay.
I did not. Go ahead, man.
Okay, because I have my notes up here. But... let's go. I really want to search for yield in the market because the S&P 500, the NASDAQ, the Dow, all hovering around record highs. And I think people need to be picky. I think tech stocks have had a great run, and you don't really want to buy during a great run, right? The whole phrase is like you buy low and you sell high. Well, right now we're high, so you don't really want to buy into those things, but we do want to look for yield. And my individual stock pick for a decent dividend is Lockheed Martin. I like them. They've got decent returns, and I just think it's a good individual pick. But you could also go look for dividend ETFs. So I've got a couple here. For example, the iShares Select Dividend ETF, ticker symbol DVY. They use a screening methodology that demands 5 years of consistent payouts. So this ensures reliability of dividends, right? This fund has about 100 holdings. The top two are natural gas firm O&Oak and the tobacco giant Altria Group. It boasts also a generous yield with only 19% of assets in its top 10 holdings. So they're prioritizing diversification here. And the yield for this fund is 2.99%. It's a relatively safe fund. Now, I mentioned before that I think that American equities are pretty high in value. Go ahead, Dave.
So, hold up. I get where you're headed with this, right? You want to go for the high yield investments, put your money in during times of these higher inflation periods, right?
Mm-hmm.
But a yield of 2.9% when inflation is roaring roaring over 5%, you're losing money, brother.
Well, that's if only you're getting that 2.9%. You also want the stock itself or the ETF to gain value, and hopefully on top of that, you're making money.
Gotcha. And I can see that for Lockheed Martin.
Yes.
Some of these other ones, I don't know, man. I don't know.
Well, I do think that you need to be selective here. I don't think so. Let's talk about the risk here, okay? The risk and dividends. The biggest risk.
I liked your idea before, like 5 episodes back, when you brought up a possibility of a high inflationary last and long term. You wanted to look for companies with a higher margin, and you brought up Apple as an example, and so on and so forth. That was, I was behind you 100% on that one.
Well, that's because that translates into return on equity, right? Which then translates into either higher dividends or more buybacks.
Gotcha.
Now, a good company that is just like it's getting beat down into the dirt right now, Alibaba, they just announced a fairly large buyback program. So if you want to go the buyback route, then Alibaba could be a good play as well. You just have to kind of hold your nose through all of this uncertainty that regulatory issues are bringing about, and also the recent rape investigation, which it was really an employee that claims she was raped by her supervisor. The supervisor is now arrested and out of the company, along with a couple of other people too. So that there's that going on for them. But I still think long term, Alibaba is good too for buybacks and dividends. One of the risks, rising interest rates. So if we start to see that 10-year kick up a little bit, then some of these dividend-paying stocks might actually come down. Companies that typically have the highest dividend yields are in sectors that have the heaviest debt loads, like utilities, telecommunications, real estate investment trusts, and so on. So you really, like, the top question here to ask yourself, does the company have sufficient net income to pay off its long-term debt within 4 years? Lockheed Martin does. Go ahead, Dave.
Yeah, and I like your premise there and where you're going with all that. I just want to talk about one statement you said there in regards to yields, whether yields stay the same. If the Fed cuts its QE, which we on this show, I believe, was it 2 or 3 weeks ago on the show, I was quoting certain regional Fed Reserve guys saying that they want to cut in October. They want to cut. And then today, all over the news, all day, because, I had the day off and I'm just sitting here watching CNBC because that's what I do. All day on CNBC. Oh, we're going to go ahead and we're going to go start tapering in October. Start tapering in October. Is that going to cause the yields to rise?
It will cause them, I think, temporarily at least to rise, but I don't think the Fed's actually going to start raising interest rates until the end of the year, next year.
No, they have to. So we disagree on this, and I want to talk about that.
No, I think that the Fed says these are two different things. They're two different things. So they're forecasting a raise in interest rates at the end of next year, but talking about tapering this year.
Yeah, interest rates, one thing. Bond yields and cutting the Fed QE bond purchasing program and how that will affect bond yields is another. You're right. Interest rates is one thing. Bond yields are another. And in your statement tonight, you mentioned about, this is if bond yields stay right where they're. Why? I don't know if they're going to stay right where they're. If the Fed starts cutting how much they're going to spend buying bonds, and the bond yields might rise. And the Feds have to. They're put in a position, the current administration and the Fed is in a rock and a hard place here.
Yeah.
All right? You have all these, you have super high inflation that's just rocketing through that we haven't seen since, decades, right? We haven't seen this type of inflation in the long term. The younger people today in their 20s will have no idea what we're talking about, and they'll be shocked when they see sticker prices and everything jump up the way it is. But for the older people, they're going to understand they've seen this before, but it's been a while, right?
Yeah.
So you have super high inflation. The Fed has to cut back somewhere on the spending in order to keep the inflation tamed, because they can't. That's the Fed's job. One of the Fed's jobs, they have very few jobs that they're responsible for, which is ridiculous, but one of the few things they have is inflation. and they can't let it run wild and have super high inflation. We can't have that, Brandon, and they know that, and so they have to cut somewhere, and they're going to cut back on how much
they're going to cut back on. Yeah, they're going to cut back on the
bond yields to rise.
But I don't think they're going to shock the markets. There may be a short-term shock to bonds. There may, which I think are in a bubble right now, and long-term they're dead. Because they don't yield anything. That was
going to be one of my follow-up questions. Are they still dead?
The bond prices have been on fire, but there's no reason. Just like I said this back in March when we first started the show, there is no good reason to make a long-term investment in bonds right now. There's just not. But with that being said, the Fed has been at record rates buying bonds. So if they're just tapering, if they're just cutting back on this, they're still going to be buying. They're still going to be buying a lot. I think if the 10-year goes up, maybe by the end of the year we hit 2%, but that's still low, you know? That's not like insanely high. It's from where we're at right now, 1.25% to 2% would be a short-term shock. But in the long term, the idea that I have right now still remains intact.
At a 2% 10-year, your numbers still run true. Is that what you're saying?
Yes.
Okay. All right.
So
I have more to say on this inflation, but you continue.
But you want a sufficient, because when you have a company that has a lot of long-term debt, interest rates rise, a company with a high debt load, they then see their debt servicing costs go up because they'll have to pay a greater amount of interest on these debts. So this will have an adverse effect on its profitability, right? So, and another impact that higher interest rates have, that's on discounted cash flows. A future earning stream, say for example, if you have a future earning stream of $100, we'll just use that as an example. That's got a smaller present value when it's discounted at a rate of 4% rather than 3%. That 1% makes a huge difference here. I just got that example from Investopedia, so I'm citing my source here. So you really, I want you to hunt for yields, but I also want you to be very selective. Financials are good when the rates rise, right? And they often pay out a decent dividend. I've mentioned Jefferies on this program. We did a deep dive into Jefferies not too long ago. They've got I think their dividend payout's a little bit over 2%. So that's okay as well, right? But you really want to look at that. Does the company have sufficient net income to pay off its long-term debt within 4 years? Now let's go back into the dividend ETFs. So if you want to be a little bit more diversified, I mentioned the iShares Select Dividend ETF, DVY is the ticker here. If you want to be a little bit more risky, there's a Global X Super Dividend ETF, SDIV. Now what I like about this, I mentioned earlier in this podcast that I think the S&P 500, the QQQ, and the Dow all hovering near record highs. You might not want to buy those companies, right? So what I like about this is that less than 30% of the companies here are U.S. companies. Now, you're exposing yourself to a little bit more risk because you're investing internationally. They have small Chinese companies that you may have never heard of before. But the idea here is that roughly just 100 of these names will be diversified enough to prevent volatility. So there is a focus on diversification here, and the current yield is at 6.65%. So just with that yield, you're beating inflation.
Nice.
Now, like I said, now here's my pick, though. My pick, if you want to do those two there, but then there's my favorite personally is the S&P 500 Dividend Aristocrats ETF. The reason is that they only have stocks that have consistently raised their dividends every year for 25 consecutive years. So you have quality companies. They're diversified as well. And this ETF tends to weather downturns downtrends better than other ETFs and better than other individual stocks as well. Their top
Do you have
10.
a ticker symbol, or say that name one more time slowly?
It is NOBL. That is the ticker symbol.
Gotcha.
It
And
is
it's the S&P what?
S&P 500 Dividend Aristocrats ETF.
Gotcha.
NOBL. Noble. Top 10 holdings for them: Nucor Corp, Target, ExxonMobil, Expeditors International Washington, West Pharmaceutical Services, Franklin Resources, Roper Technologies, Cintas, and Federal Realty Investment Trust. So they do have some REITs in there, but they also have financials. They've also got energy. They've also got retail. Those are some good picks, in my opinion.
Gotcha. I mean, I completely agree. I like those picks.
I also like
I like your angle here at trying to play the inflation and where to go with the dividend yield.
Yeah, you have to be careful because, like I said, when interest rates go up, dividend stocks go down, except with finances, and then I think also except with high quality names. Add Coca-Cola to this too. They've got an okay dividend.
Yeah. Add Coca-Cola. There you go, man. I like that. I like your play. I like how you're working the inflation trade. I still believe NVDA. If you're thinking that we're gonna have high inflation for the longer term, NVIDIA is a great play. And right now it took a hit down, so now is a good time to get in.
Mm-hmm.
It went down to 195. I think it jumped back up to 198 at the end of the day. So it's still below that 200 mark, which is near the highs. But I mean, come on, NVIDIA is leading in chip production, I believe, for a long term. So NVIDIA is a great play.
I like NVIDIA.
I like Lockheed. I like your play on Lockheed Martin, especially with us pulling out of Afghanistan and everything that's going on there, and the fact that we're going to have to be, if we're going to do any offensive movements going forward, it's going to have to be shooting missiles from battleships and helicopters,
and drones.
So that means more of Lockheed Martin's missiles are going to be used, and so it's a play there as well.
It's also a space play.
Yeah, you're right. I forgot all about that. It is also a space play. So
now, dividend stocks, in regards to price to earnings, they generally trade at a 5 to 10% premium to the S&P 500 price to earnings. Right now, they're at about a 15% discount. So if you're wondering why, with expectations on the rise that interest rates might go up, why I'm recommending these dividend ETFs at the same time, I think that those expectations are being priced in, and I just think you got to be selective about it.
You really always have to be selective. Everybody needs to do your research and make sure that this is something that's right for you. You really have to. I don't think people understand how much research you and I put into our picks and how much we've, like, by the time we post something on Instagram, I know everything about that company and the board of directors is, where their CFO went to high school. I mean, it's ridiculous how much research we do, but at the same time, it's like it's necessary to fully understand the companies and why we're calling these as good calls.
Yeah, and if you know what, these three picks that I have here, they have low expense ratios, which is great. If you're going out looking for these ETFs too, you have to do your research on ETFs also. You can't just buy an ETF and passively buy it and just let it sit. You have to look at expense ratios on these as well.
Right? All ETFs go up, right, Brendan?
Yes. No.
No, they don't, guys. No. We're being sarcastic. No. Yeah, so Brandon, just to reiterate, what are your three calls one last time? To give us names and tickers.
ETFs. Okay, three calls on ETFs. I like iShares Select Dividend ETF DVY. I like Global X Super Dividend ETF. That's SDIV. And then NOBL, the S&P 500 Dividend Aristocrats ETF. And then my individual stock pick is Lockheed Martin. And to round out my segment, right now, I mentioned this last week, I bought Take-Two Interactive. I think right now you buy it again.
Wow, actual buy call.
Yes.
On the show from Brandon. Take-Two Interactive.
I mean, you got Christmas coming up.
Not just because he's a Red Dead fan. Not just because he's a Red Dead fan.
No, I'm diversified in my Take-Two. Okay, video games. I like NBA. I like Grand Theft Auto. Okay, those are great video games. Yeah. Also, Christmas is coming up. Okay, so why not buy it while it's had some pressure on it?
Gotcha. All right. So I'm gonna go back to this inflation here because I got a few comments to make on this, man. All right. I want to give you some examples of how inflation is affecting everyday people. Right. The average parent was spending $270 this year, compared to $250 for back-to-school supplies. Year over year, it's a $20 increase, right? I'm going to read this next it's a couple sentences, so bear with me, and it's a quote. It's an exact quote from an article on CNBC, all right? So, quote, consumer prices in May accelerated at the fastest pace in nearly 13 years. A sign of how much inflationary pressure is building in the U.S. economy. Apparel prices rose 1.2% from April. Footwear prices jumped 1.4%. The cost of educational books and supplies rose 0.7% month over month, according to the latest data from the Labor Department. End quote. Inflation is hitting people's pocketbooks, right? Right now, people are starting to feel these inflations hit them everywhere they go. As far as the gas pump, food prices, as far as now with back to school supplies, apparel. These 1.4 or 1.2 jumps in just 2 months is outrageous. Because you think about, we talk about inflation as a yearly inflation number of like what 4% on average, and we're jumping 1.4% in just 2 months. That's going to kill people's pocketbooks. That means if you get a 4% raise this year at your job, you're losing money. You're actually making less money than what you made the year before because of inflation. And this is because the cost of goods are going up. Now, on top of this, and this is why I made the comment that the current administration find themselves in the rock and a hard place. On top of this, supplies and inventories are extremely low in retail across the board. You have container ships that are sitting at docks because we cannot move them. We have containers sitting at rail yards because the rail lines are completely packed and busy. They're moving as much as they can. They can't move them fast enough. The United States is sending empty containers back to China just to get more goods here faster. We're deadheading container ships back to China because we want them to send us more stuff because we are so low on everything. Now, the reason why a lot of companies are posting great numbers is their inventories has been low. You know, you have your employment, right? The number of coworkers working for them low because they had to do a lot of cuts. They streamlined their businesses, and so their revenue, the top line number hasn't grown that much, but the bottom line number looks great. Well, they eventually are going to get these inventories back on the books. You know, these numbers aren't always going to look this great for these companies. What we're going to see if we continue at this pace is we're going to see shelves emptier than what we're used to with prices higher, and it didn't take us long to get here.
I guess, we'll see what happens. I mean, being somebody, I work for a retail company. My current job makes me, it has me responsible for gross margin, gross profit, all that stuff. And I can tell you right now, though, we have to turn away so many customers because we don't have the products that they want. So hopefully there's a backlog of demand to fill that gap once that inventory actually does come in. But how long does that last?
And what are the prices going to be once the inventory comes in?
Yeah, I can tell you also, I just spent $300 on groceries for 2 weeks for 2 people. 2 people.
This is what people are not considering in this economy. And so when I look at stocks, I look at, okay, what are we going to need? Because we're going to get to a period where people are only going to buy what they need for a short period of time to get back on track, if you will. You know what I mean?
Yeah.
Rebalance their household budgets. All right. So what are they're gonna need? You know, I mean, Kroger is always going to be a good stock to play during those times because they're always people need groceries. You know.
Mm-hmm.
Kroger has withstood the Amazon onslaught of online ordering, and they're still here. And they readjusted theirs to online ordering and in store and trying to get less employees and using these electronic baskets now. I see at Kroger's where you can scan your own goods and just walk out and trying to make it a shopping experience where you don't have to interact with people. They're trying to build it that way, right?
Mm-hmm.
So you see companies like this adapting to it, and I feel you got to look for plays to where if the economy takes, here I go being the bear again, and a negative turn. I don't think it will if we do the right things now, Brandon. If we do this QE tapering, we start cutting there. I understand that we have to pass spending bills every year, right? Got to pay to run our government. Whether or not we can all sit here and talk politics and agree on how much or whatnot. We got to pass spending bills every year. Unfortunately, it takes trillions of dollars to run it. We do need to watch how much we spend on that because it adds to inflation if we just printed money. We got to bring in that much. Our GDP has to hit certain numbers. And what I'm looking for in our GDP coming up, the next GDP numbers I'm looking for, anything above 6.5 would be great news. That means we have enough coming in to cover our spending.
Yeah. Take politics out of this for a second. Just think about this.
I thought it was.
No, you are. I'm speaking to the listener here.
Yeah.
As much as it sounds great to put an EV charger at every restaurant or rest stop, every gas station, all of that. $4.5 trillion is what we're looking at spending this year. That comes back to higher prices, right? This is equal to a regressive tax because the people that pay for this the most are individual, middle class, working class, and poor people. They bear the cost here. The big banks that a lot of people tend to hate and big corporations, they get money prior to us getting money, okay? Which means they get the money on their balance sheets and income statements before it loses most of its value. Whereas when that money actually gets to us, it's already lost most of its value. So we've already lost the purchasing power. The rich corporations are not losing as much spending power as we are. Go ahead.
So we actually covered this when you were gone. We had a gentleman on here called Nick Young, and we talked a little bit about the velocity of a dollar.
Yes.
And that's what you're talking about right now is what I believe. And let me explain this to the everyday people one last time here. Velocity of a dollar. So when you hear that saying, what that means is when a dollar is printed and made, boom, boom, we have this $1, right? How many times can that dollar be used before it gets withered down to 0 cents? Meaning, if I go to the store and I use that dollar and I buy a 95-cent thing, I pay 5 cents in taxes, boom, we lost 5% of that value, right? Because I only bought a 95-cent thing. So the store that I paid them only got 95 cents, but I gave them $1. Mm-hmm. So when that store goes ahead and pays their employees' salary at 95 cents, I'm just using this for example, they got to pay taxes on that and say they're at a 30% tax, 20% tax rate, you taking off, now you're down at 75 cents on the dollar.
Right.
The velocity of a dollar means how many times over before that dollar reaches 0. how many times does it get taxed before the actual value of that $1 has reached zero? And you want that velocity to be as large number as possible, because that means you're in a healthy, strong economy. When you're not, and that velocity takes fewer steps to get down to zero, that means you're in a bad shape economy, and you need to fix some things. That's what Brandon is talking about here, guys.
I love this
He's talking about the theory of a velocity of a dollar.
Yes. And there's trade-offs to everything. So you could have all of your pet spending projects and everything that, is in goodwill, and then you can go back and you can point to, the post-World War II spending led to the greatest expansion of an economy, and there's so many different statistics that you can use to try to prove that or disprove it. But then you could also look at the great inflation, stagflation situation of the 1970s, because that was caused by all of that spending that happened. There is a trade-off to everything you do in the economy. So you get what I'm saying?
Yeah.
You're going to pay for it no matter what. Whether you're taxing people or whether it's through inflation, these spending programs get paid for. They have to.
And you need to spend. Like I said, the spending bill is just a government funding bill. It's just paying us to run the government. And it has to be done. And we just you always prefer it to be as little as possible. But you still need to pass a bill, and that's why I said GDP numbers. When you guys are watching CNBC or Bloomberg or Cheddar News or Fox Business, whatever show you watch, you want a GDP number to be around 6.5 or higher, just so that we make sure we're heading enough GDP to cover these spending bills immediately and not passing the buck down the road. That looks to be a stretch. Our last GDP number is 6.2, and so we're not looking like we're going to hit that. But you never know. If we get labor back into the workforce, if we have unemployment drop down like it needs to, because people are hiring everywhere, we could see that, Brandon.
I hope so. I don't know. Just about half this country was shut down last year. So these numbers should be looking a lot better. It should be easy to hit that 6.5%. You're coming from almost nothing, even with the supply shortage right now.
Yeah, and the supply shortage has me worried, but that could be just a short-term to medium-term hurdle that we overcome there in that regards. I know the longshoreman, the LA Port Authority CEO was on CNBC this morning. He was talking about his longshoremen are working 6-day weeks right now, trying to hurry up and get freight in as fast as possible. They just don't have enough truck drivers on the other end to move it out, and that's where they're seeing some issues.
Yeah.
So it's issues all around.
Issues.
I will give you this. I will give you guys some hope, because we want everybody to make money. That's our goal here, is so that you could be working your 40-hour week job or 50-hour week job, and then you could listen to our podcast and you could find, okay, I can make a little extra 5% on my $1,000 I got on my Robinhood this week, and grow that, and then next week 5%, that next week 5%, and before you know it, you have tens of thousands of dollars, right? Mm-hmm. That's the goal. That's what we want out of everybody here. So what I'm looking at right now, guys, is because I'm going to switch from inflation, if you don't mind, Brandon. Let's hear something else.
No, I'm good.
All right. What I'm looking at right now is Blink. I posted this on our Instagram. If I could talk, I posted this on our Instagram, and I said it was a good buy, right? Because it took a big drop down. It dropped down to right at the bell. It dropped down to $31.50. You can see a big sharp V right at the bell there, but then it jumped back up. So it's hovering right around $32 a share right now, which is a good spot to buy in, right? Because that's where it channels at. Blink has been channeling right in between there. Blink's going to be a big receiver of this new infrastructure bill. I believe there's a lot of growth with Blink. It's not just in U.S. It's a global company. They have contracts in Germany and Europe. They have contracts in certain parts near Asia. So they are everywhere. Blink is a global company, and they are growing in that respect as far as EV charging and setting up charger stations and so forth. That's their biggest money maker, if you will. So I do see more long-term growth in Blink, and I believe that right now, in the short term, since it did take this big drop back down, it is a good buying opportunity to get in.
Yeah, I agree. And we talked about this last week, too, as far as the infrastructure bill goes.
Right, and we said wait for it,
Yeah.
wait for a drop back, a pull back, and get in on the pullback. Well, it had its pullback, guys, so now's the time to get in. Now, also in regards to that, if you want something more long term, I'm gonna talk a little bit about KULR real quick, because I know we're getting longer on time here. We want to make sure you guys enjoy your day, not just listen to us all day long. But KULR, right, KULR Technology. I've mentioned this before on the show, so. KULR Technology has made the right, if you will, contracts, relationships with the right people. Right? They've talked to Airbus. They've have worked with NASA. They've worked with everybody in regards to lithium-ion batteries and how to make batteries better. Which that's the way that this world is going, is in battery technology, EVs. You hear about it all the time, electronic vehicles. They're going to be using batteries. Well, KULR Technology is making batteries better, and so they are ahead of the game here with their technology. I want you guys to take a look at them, research them, but when you look at them and you see that their stock's hanging around, between $1.50 and $2.50 a share, don't be discouraged. They're going to sit there for a while. So right now is the time. If you got it, like an extra $50, throw it in there every week or every paycheck. And build your position while it's low cost. Because what I see happening is the same thing that happened to Blink Charging. Blink Charging hung around $1 to $2 a share for almost 2 years before all of a sudden this shot up to like $46 a share, right? I don't know if KULR's going to shoot up to $46, but I believe once they start commercializing and profiting off of their innovations, you will see a big gap up, So right now is the time to be building your positions. Right now is the time. This is a long-term play. We're talking 2 to 3 year play, but build your position now so that in 2 to 3 years, when it takes that giant gap up, you've made a ton of money and you're happy and you can turn around and say, guys, look what I did,
Mm-hmm.
Anyways, that's what I got. Brandon, final thoughts?
Ticker symbols KULR, BLNK. We've got a lot here, so I'm just reiterating. DVY for the iShares Select Dividend ETF, SDIV for Global X Super Dividend, LMT for Lockheed Martin, and NOBL for the S&P 500 Dividend Aristocrats ETF. Those are the ticker symbols we were talking about today.
There you go. And those ETFs, guys, are what Brandon, and I actually agree with him, are plays, no matter if inflation's going higher or what, those are good plays put out by him, and I like that, especially the Lockheed Martin play. Those are definitely some good plays there. So
yeah. I think with this situation in Afghanistan, there might be some talk of us returning to Afghanistan. Who knows? I don't know if that's going to happen or not, but no matter what, I think there's going to be talk in the future. Once we get through this portion of the COVID Delta variant, there's going to be politicians talking about modernizing the military, strengthening the home front, all of that stuff. Lockheed Martin is a good play for that.
There you go. My point being, no matter if you have high inflation, no matter if you have a recession, no matter if you're in times of positive, you can always find some way to make 5% a week off the stock market. Yep. That's why it's a beautiful mechanism for creating wealth in America today.
Oh, and I mentioned Take-Two Interactive, TTWO.
That's just because he likes Red Day, guys. I'm telling you.
It's a good play right now. If you look at the MACD, it's about to cross over on the daily. So, you can buy it tomorrow as long as if it jumps 2 to 4%, maybe don't look at it for a short term trade. You're still buying this for long term. But if you don't get that 2 to 4% jump, and tomorrow, by tomorrow or by the time you're listening to this podcast, you probably got a good short term trade on your hands. We called it for our little competition with the evil money Vikings. So
we did, yes. Go Chinchilla Pigas. All right, guys. We hope we've been entertaining, educational, and uplifting because we want everyone to make money. Except
the money Vikings. Have a good night.